Well, hello everybody. This is Heather Dreves at Central Lending. You guys are all logged in to the webinar, and I'm super excited about this today. We've got a guest speaker here, an expert on self-directed IRA. So we're going to get started here in a couple minutes. I had some people reaching out looking for the registration link. So I'm just going to wait a few more minutes to get started here so that everybody has a chance to log on, and we'll get going. We know your time's valuable, and for a lot of you folks, this is cutting into your evening with your families, so want to be mindful of your time. But just going to give it a couple extra minutes just because there was a few people looking for the registration link. Alrighty, folks, I think we're going to get started here. First, I want to encourage all of you to ask questions. This is meant to be an interactive webinar. It is not my goal to have you guys sit on a webinar for an hour and listen to myself speak, nor any of our guests. And quite honestly, this is your guys' opportunity to have direct access to somebody from probably one of the largest self-directed IRA custodians out there. So I hope you guys are prepared. I hope you brought your questions. There's no dumb questions, but again, I just want to remind all of you that I want this to be interactive. I want you guys to find value in this. So we're going to get started here. Again, my name is Heather Dreves. I'm with Central Lending, Chief Investment Advisor, and just happy to be here and educate you folks about the different types of alternative investments that are out there, and especially today, talk specifically mostly about how you guys can do this in either a tax deferred environment or even a tax free environment. So I'm going to let the experts speak to that, but just wanted to kind of give you guys an idea of what the content's going to be today. First, I need to keep our legal team happy and read you guys a real short disclosure. Not that I think there are any real short disclosures out there, but if you guys can just hold on for a second and entertain me and listen to this. And then if you could just give me like a thumbs up on the question or comment section, just so I know that you have heard the disclosure and you agree with it. So this presentation is for informational and educational purposes only, and it is not an offer to sell or a solicitation of an offer to buy any securities or other instruments through Central Florida or by any other means. This information contained herein is not intended to provide and should not be relied upon for investment, accounting, legal, or tax advice. And this article does not purport to advise you personally concerning the nature, potential, value, or suitability of any particular sector, geographic region, security, portfolio of securities, transaction, investment strategy, or other matter. No consideration has been given to the specific investment needs or risk tolerances of any recipient as part of this publication. The recipient is reminded that an investment in any security is subject to a number of risks, including the risk of total loss of capital, and that discussion herein does not contain a list of description of such relevant risk factors. Please be advised that past performance is not a guarantee of future results, and the recipient hereof should make an independent investigation of the information described herein, including consulting its own tax, legal, accounting, and other advisors about the matters discussed herein. This report does not constitute any form of invitation or inducement by Central Lending or Central Florida Income Fund to engage in investment or activity or to invest in any Central Florida Lending Income Fund product offerings. So if I haven't scared you away yet, we're going to move on here. And I can see our guest laughing at me because he's probably very familiar with disclosures. For those of you that don't know me, a little bit about myself, because I am fairly new to central lending, but excited to be here. I've been in the private money alternative investment space for over 19 years now. I've been married for 29 years, and we've got two amazing boys. Ethan, who actually is 26, not 29. He probably wouldn't appreciate that that's a typo. He's our fireman, and our younger son, Noah, who is actually almost 24. Has just graduated from college with his master's, so he's figuring out what adult life is like now. Our family's active real estate investors as well as passive investors. We currently are holding rental properties in our portfolio and also currently investing with our self-directed IRA accounts. So I'm excited about this topic today because there's a lot to learn. I've got some questions as well, as I'm sure you guys do. So there's my contact info. I encourage you guys all, if you need anything, have any questions, want to discuss things further, I am an open door. That is actually my cell phone, and I am not afraid to give that out because I am always willing and able to take calls. And if I don't answer, I'll definitely call you back. So what do we do at Central Lending? Because I think some of you, and I can see some names that are actually on the attendee list, aren't familiar or in our database. So that's great. We're always looking to grow this list of people to attend the webinar. We're actually going to do this once a month. But what do we do here? So we, first and foremost, we finance the rehabilitation of homes in the affordable housing market space. So all of you active investors that are on the webinar today, if you're out there buying properties to fix and flip, or possibly you're buying them and wholesaling them, we are a funding source for you. We also currently purchase and build affordable homes, mainly in the Central Florida market. And then we provide short-term funding for our top investors that are our active investors. But last but not least, we also provide alternative investment opportunities to our passive investors. And that's really mainly where I focus around our business, is working with our passive investors that, you know, some of the times they already own real estate and they're looking to diversify their portfolios and start to invest their dollars in real estate, but not being so hands-on, meaning not necessarily dealing with tenants and toilets and not having to deal with calling a contractor. So we actually manage several funds. We've been managing funds since 2017, just recently opened up our third fund. And this is really just a vehicle for our investors that are looking for passive investments for their dollars. And we can get a little farther into the weeds, but I want to definitely leave enough time for our guest. So we solve for our active investors. We solve problems for our passive investors that are looking for short-term investment opportunities. We also work very closely with institutional capital and then also private lenders. Some of our lenders prefer to buy what we would call promissory notes, and so we work very closely with them as well. All right, so here's to the good stuff. I was lucky enough to connect with this person. I'm very familiar with Equity Trust Company, and he came to us as a referral from another colleague. I said, hey, I need an expert that can speak to our database, our guests on this webinar, and speak specifically about the one-on-ones on self-directed IRAs. I think there's a lot of misinformation out there. A lot of people aren't familiar with it, but what I can say is everybody's looking to pay less taxes, right? Yes. So this is a way, you guys put your listening ears on. He's going to tell you all the things that you can and can't do, how to set up your accounts. And these are ways that some of the wealthiest people in the United States are creating wealth through themselves through these types of accounts. So it's a real treat that we have Matt here, Matt Calhoun with Equity Trust. So I am going to turn over the driver's seat to him so that he can share his presentation. And like I said, I want you guys to um, I want to encourage you guys to ask questions. I'm going to stop sharing my screen, and Matt, you should be able to share yours. Tell me if you cannot. But ask your questions. We will address those at the end, but this is meant to be interactive with you guys. Let's see, do I need to do anything to give
Yeah,
you
can't
here?
share just yet. Yeah, not yet.
All
There
right,
it is.
give that a try now.
Yeah, perfect. PowerPoint looks good. Why?
Can you put it in presentation mode?
Yeah. It's in presentation mode for me. It's not coming through on the feed.
No, we had this issue the other day. Let me try something. Let's see. I'm going to try to make you organizer. I want to make sure everybody can see your content. So let's see if this changes it at all for you. Oh, can you still hear us, Matt? All right, bear with us, folks. There you are.
I'm back on there. When I
Yeah, I'm not sure why it's not showing in presenter mode. I can see it okay though. For those of you that are logged on, maybe you can give us a thumbs up whether you're okay with seeing it.
no,
All right, it looks like I can see it all right. Let me just check with one other person.
yeah.
All right. Okay, yeah, someone's saying it's a third of the screen. Let's see here.
Interesting.
Okay. Um, well, I am really good at investor relations. I'm really bad at technology. I'm just going to be honest with you all.
Interesting.
Um, I say we get started here. I'll try to mess with it a little bit. I just want to be mindful of
Okay.
everybody's time. So I'm going to let you get going and I will see if I can fix it for you.
Okay. Well, thanks for having me. Sorry for the tech inconvenience there, and using your time. So, intro quick to myself. Matt Calhoun. So I'm a director at Equity Trust, and my job is really talking to individual investors who are looking to diversify their retirement accounts out of the stock market and into other types of investment, other asset classes that they just didn't know was available. I started off in the financial advising space for, I don't know, 6, 7 years, doing those mutual funds and stocks. Started investing in real estate properties myself as well, similar to Heather, and kind of found a way to merge the two. So using the knowledge of retirement accounts and ways to accumulate wealth on that side, and then use that for real estate is a very common investment in self-directed IRAs. I actually didn't know at the time that there were so many other options as well available to the self-directed IRA space. And today we'll talk at least a pretty basic understanding of what options you have, how to use that vehicle, or as I refer to it, an extra tool in your investor tool belt, um, in a tax deferred way or a tax smart way to invest in other asset classes. My contact information is there. Feel free to reach out. Like I said, definitely encourage questions. But if there's something you didn't think of while we're here live, you think about later, feel free to call me, send me an email. But that information will be at the end as well. So if you want to grab that. Next slide. A little bit about equity trust. So equity trust is the one of, if not the one of the largest self-directed IRA administrators in the country. So and by a large margin. Been around for 50 years, so we're celebrating the 50th anniversary of the institution this year. Um, Nearly over $300,000 or 300,000 individual account holders, 45 billion in assets under administration. So Equitrust has a lot of experience in working with different investors and different investments, um, and oversees a lot of investable assets as well. I came from a company known as Midland Trust is on there, which was acquired in 2023 and rebranded as Equity Institutional. So there's certain asset classes that Equity Institutional specializes in, and this is very common with equity. We know that there's certain parts of the company that's going to basically be the best spot for our clients, and we make sure those, you know, associates specialize in those asset classes. The institutional side, the part of, has offices in Chicago, Cleveland, and Fort Myers, Florida, which where I'm located is Fort Myers, Florida. Um, Equity Trust is based out of Westlake, Ohio, and has offices around the country. Um, our individual part of equity was listed as the best for private equity by Forbes Advisors recently, just recognizing that specialty in certain asset classes. So most of what we're here to talk about is what is a self-directed IRA. It's a great buzzword that gets thrown around a lot. Even on the brokerage side, people will kind of co-op it, and some people just don't know what it means. You may have heard the term. I get asked the question quite a bit, and my answer always is there actually is no difference between in a self-directed IRA and a regular IRA, according to the U.S. government. When IRAs were created in the 70s, um, basically the only assets you could not invest in when the law passed was life insurance and collectibles, so antiques, pieces of art directly. Everything else was available to be held in the retirement account. The institutions that really grabbed a hold of IRAs were, your Schwabs, your Fidelities, your large brokerages that you're very familiar with, and have a lot of probably retirement accounts there. They already sell stocks, bonds, mutual funds. So they said it's a perfect fit. We'll continue to do that. And over the years, many people thought that's the only thing you can hold in there. Myself included, you have a 401k, there's a list of mutual funds I can put it in. That's all I can hold in a retirement account. And I have to do all my other investing outside of a retirement account. Institutions like equity exist to allow to invest in all those other asset classes that got ignored, being able to hold in a retirement account and still get that same tax advantage that you have in those accounts. So if you have an account in IRA at a Schwab, a Fidelity, or other institutions, likely it's not truly self-directed and that you can't choose your investments across investment asset classes. You're just stuck with the stocks, bonds, mutual funds that they sell you. So you're really looking for a specified custodian who can hold these asset classes and wants to hold these asset classes. So started IRAs, like I said, definitely a retirement account just for alternatives. Focus on a lot of passive investing. I mentioned different asset classes, so pretty commonly we'd see real estate, private equity, private debt, some futures and forex, private notes, and many more. I was telling somebody that we have a person who invests in racehorses, so startup companies. A lot of different asset classes are available to retirement accounts. People get pretty creative with what they hold. A self-directed IRA custodian is needed to have those accounts. So, sometimes people think they can just do it on their own, or, oh, well, my E-Trade account, I'll just take money out. You really want to go through a self-directed IRA custodian to make sure everything's done correctly and you still keep that tax advantage status of those accounts. I can tell stories of people who thought they had a self-directed IRA and they end up not, and it costing a lot of money, thousands of dollars.
And if I could just interject, I
Yes.
hear these horror stories as well. And
Yeah.
I get these people that call up, well, I don't want to pay the custodian all these fees. And a custodian is there for guardrails. And Unless you are a very sophisticated person and you're interested in doing all the paperwork and the filings and making sure that you're not doing something that's a prohibited transaction, I would highly suggest using a custodian, because I have heard the horror stories as well, Matt. And correct me if I'm wrong, if you are doing prohibited transactions, things that you are not allowed to do inside of your IRA, they can actually come in and unwind it, and it would be a tax event, correct?
Yeah, in many cases, it's a forced distribution, and you're going to get a 1099 for the value of your investment. So not only maybe what you put into it, but if it's grown during that time period too, you're
Right.
actually going to get paid taxes on the growth as well. Um,
Yeah.
and if a prohibited transaction, especially, has occurred, another custodian can't step in either. It's probably going to be a taxable event. So yeah, definitely worth having an expert be involved throughout the process. So advantages of using a self-directed IRA. Some of these apply to regular IRAs as well. And I should say, like when you're opening a self-directed IRA, you're opening a traditional, a Roth, a SEP, a simple IRA. The IRA types that you're familiar with, that you probably already currently have, you're opening the same type of accounts here. You're just really looking for a custodian that specializes there. So some of these advantages, like tax advantages, they're the same between those two accounts. If it's a traditional IRA, you're getting that tax deferred growth as you're investing, selling investments, making gains. You're not paying capital gains taxes or anything else. Those, I guess, proceeds are all rolling in, and you're compounding your growth absent taxation. And what you mentioned on a Roth account, we're talking about tax-free for the life of the account and withdrawals. Um, so huge wealth building tool there with the tax advantages of retirement accounts. Investment options. This one we're talking about specifically for self-directed IRAs. Like I said, opening up all those different asset classes to those tax deferred accounts. Like I said, some people like it for the fact they can invest in things they know or asset classes they think they can get better returns on. It just gives you those options beyond what you probably have available. Administrative fees, we talk about it being, a little higher, and it may be, but the nice thing about self-directed custodians is they're upfront. They tell you what there are. There's a fee schedule that says everything you'll be charged. With coming from the stock bond mutual fund world, there's a lot of hidden fees that you just think like, well, I'm not paying anything. I'm not charging any fees, not knowing there's 12b1 fees, commission fees, and administrative fees. Like it just gets hidden in there, and really to find out even in your 401k what kind of fees you're charged, it's really hard. Like you have to look through statements, disclosures. We had a colleague who I think it was close to like 1.5% they were getting charged in 401k fees. They didn't even know. It's not even on the statement. It doesn't show fees or anything like that. So the benefit of the self-directed space is you're signing a fee disclosure. It says exactly what you're going to pay, and you know that ahead of time, and it is what it is. There's no hidden fees there. And then true diversification. We talk about investing savviness being, oh, we want to be diversified, not all my eggs in one basket. And we think that means, mutual funds or a lot of different stocks. I was talking to a group before, and it was just a day where NVIDIA had gone down quite a bit. I don't own NVIDIA stock anywhere, and my portfolio dropped because NVIDIA had a bad day. I'm like, well, I'm diversified across, but one stock had a bad day, and all these other stocks came down. So true diversification is being able to invest in other asset classes that aren't kind of tied to what the S&P 500 is doing that day. So a lot of popular reasons people will use their retirement accounts for these investments. I'll have a bonus one here is four reasons, but we talk about diversification, being able to maybe you have the 401k or a different IRA that's held in brokerage accounts, but this gives you the ability to either use some of that portfolio to look in different asset classes or have a different account that invests in different asset classes as well. Job change is a big one. The most common retirement account people use is 401ks, 403bs, 457s, something they've worked for an employer, added money to these plans for years and years. They make a job change. That's a key event where those funds are now able to be rolled over into an IRA. So this is kind of a great time to move it out of that 401k and explore what other options you have. Illiquidity. So I'll kind of say this is kind of an access to capital thing, where many times we're talking to investment sponsors who are talking to investors like, well, I'd really like to invest in your investment. My money's just tied up. I don't have enough money in the savings account. My investable dollars just aren't there. Not realizing for most Americans, their largest investable assets are held in retirement accounts. And just not knowing those can be deployed into deals like this as well. So basically opens up the opportunities for just access to capital that you just didn't know you had before. And then tax mitigation, we talked about this, but it really can't go without saying the power of growing a portfolio absent taxation is huge. Most people realize some of the largest expenses you're going to pay in your lifetime are through taxes, sales tax, capital gains tax, income tax. Being able to defer those while you're growing that portfolio can be huge because that's more money that goes into your next deal and so on and so on versus having to give Uncle Sam a cut each time you make a profit on investment. So very great wealth building tool. And like we talked about, it's great in a traditional IRA. If you have a Roth, sometimes even better because we're talking about tax free even when you pull out the money in retirement. So what type of accounts can be used? Like I said, on the employer plan side, where we talked about 401k, 403b, and 457 are what we see most commonly. That's not it. Those are just ones that, because I think that probably encompasses 80% of employer plans, but we'll see pensions, 401a, different plans there. Um, if it's a current employer, very likely those funds are probably locked up. They don't really like you moving funds out while you're currently employed. Um, Sometimes there's an age like that triggers it. So 59 and a half is pretty common, 65. Once you obtain a certain age, sometimes even if you're still employed, you can move those funds out. It varies depending on your employer. So I tell people a lot of times maybe it's worth a call to HR and just kind of see when your 401k is eligible to be moved over, whether that's a partial amount or a full amount, just so you can get it out and start getting into these different investments. But once you leave an employer, 100% it's guaranteed you can move it out to a self-directed IRA. And then individual retirement accounts. So if you're already in a traditional, a Roth, a SEP, or a simple IRA, and some other different options, those 100% can be moved into a self-directed IRA. It's a very easy process. Basically, submit a request to that custodian for a certain amount, the full account, however you want to do that. And within generally 3 to 10 days, we're going to have money from that account. It's not reportable. There's no penalties, no taxes on that transfer. So a very easy process there. So I could probably spend an hour talking about every different asset class we offer. I just threw in a couple slides about investing in debt offerings. But like I said, a lot of this will apply to any type of asset class. So we mentioned retirement funds can be sourced for these types of investments. Every single day I hear people like, I didn't know I could do this. Like, why didn't I know I could do this? No one tells me that I can use retirement funds to invest in these asset classes. So that's a big key. So what we talk about is making sure that the IRA doesn't, or basically the IRA investment isn't violating any prohibited transaction rules, but also making sure the I's are dotted and the T's are crossed. On any type of investment document, the IRA has a special way of being listed. So as a custodian, we're making sure that's done correctly. In many cases, we're pre-filling all those documents to make sure they're done correctly with a separate tax ID. So we don't want the investor's social security number on. We want it very clear that this is a IRA account, a tax deferred entity that's doing this investment. And that's part of the role of a custodian and why we do what we do is to make sure everything's done correctly. That for whatever reason, if the IRS was to look at this, they know, yes, 100% the IRA is in good shape and this is an IRA investment. Funds are released from the IRA custodian. So as I mentioned, that transfer over of funds, we deposit the funds in your retirement account that you'd have with Equity Trust. We would wire them out to the investment sponsor for the investment you're looking to do. And then any incoming investment, so dividends, rental income, any type of investment that comes back is deposited back in your retirement account. If certain investment classes, if there's capital calls or expenses, those funds are sent out of your retirement account as well. So real estate's the best example because if you have property taxes, the IRA is going to cut the check to the county for your property taxes for that year. Some don't have expenses, but just keep in mind anything in and out for that investment goes through the retirement account. Even if you plan on taking those funds out as a distribution later, goes back to the IRA first, and then the custodian can send you your distribution and do the proper tax reporting on that.
And
And then
one thing I
returns can
would, one caveat on that I just wanted to mention is depending upon which sponsor you're working with, like whether you're working with central lending or some other sponsor, fund operator, a lot of times, and what they should be doing is helping you kind of navigate this. Not that we would give you advice, but if you were, for example, wanting to invest with us in our fund, we would help you fill that form out because there's a lot of information that your sponsor is going to need to give you. We even go to the extent of submitting it on behalf of them to Equity Trust. Obviously, the account holder would need to read and approve everything, but I think sometimes people get a little overwhelmed with the forms and things like that. But if you're aligning yourself with a good sponsor, they should be helping you do those kind of things. Obviously, Matt and his team are the experts of what you can and can't do. But just on a side note, because I get calls and people are like, I have no idea how to fill this form out. A good sponsor should be helping you do that.
Yeah,
Sorry to
that's great.
interrupt.
No, not at all. It's a good add-on. And then speaking specifically, I have debt offering on there. One big benefit and something to think about is, deploying these retirement accounts into assets that maybe you weren't going to get the best tax mitigation strategies without. So, sometimes people talk about real estate. They're like, oh, well, I kind of get some tax benefits outside of it, and I don't really pay a tax bill anyways. Especially debt offerings, there's no write-offs at that point. Like it's very hard to mitigate the taxes on returns you get for debt offerings. That's where you would use a tax deferred account to do these types of investments. But that, different across different asset classes, just a good thing to think about is, maybe picking your investments on, you know, well, the other part of it is, especially with real estate, because I talked to somebody the other day, I'm like, it's also nice to not have to worry about it. You don't have to look at all these different options because you just know your investment's going to be tax deferred.
Yeah, that's a good point.
Tips and consideration, I said, we'll add on there just because it is an important point, is you must engage an IRA custodian or administrator, whether that's Equity Trust or someone else. Um, to add a little detail to one of the horror stories, I had a guy who hit an E-Trade account and he invested into this REIT, and he thought his E-Trade account was holding this REIT investment. It was $250,000 that E-Trade had distributed it to him. Basically, he took a withdrawal from his retirement
Oh
account and
no.
put the money in. And if he did it quick enough, and we could have resolved it. He didn't want to pay any fee, and it ended up costing him, like, he's going to get a 1099 for $250,000. He's going to pay
Ugh,
taxes on that distribution. And for over a year, he thought he had done it correctly, and he just didn't. He was just plain wrong. So, yeah, I hear those quite a bit. Like, maybe not quite that much, but it does happen. So it's very important. Do the homework ahead of time. Make sure it's done correctly.
yep.
Kind of mentioned the investment's done in the name of the retirement account with its own tax ID, and then cash flows come in back in to the retirement account as well. Lead time is important. So if you're looking at a retirement account, normally within a week, we could actually fund an investment, but it's nice to give yourself at least 2 to 3 weeks, depending on where the funds are coming from. So if it's a 401k, they're in no hurry to get rid of that money from your 401k. They kind of want to hold it a little bit longer. They're going to mail you a check. Try to give 2 or 3 weeks before your investment deadline. Like I said, it can be done much quicker, but the last thing we do is miss out on a good deal because we're waiting on Fidelity to cut a check, and then the mail's
Yeah.
taking a little bit long. So good to have that. And then we kind of mentioned active 401ks, very likely off limits. Not in all cases, so it's still worth maybe a try. And if you're a business owner, maybe there's ways to change your own 401k. I've had that as well. But for most people who are working a job and you're active, your current 401k is not going to be able to be used most likely for a self-directed IRA. As far as steps, like I said, we've kind of alluded to these, but really it's opening the account. There's a link. We have an online application. Other custodians do too. Everything can be done online. You can DocuSign, you can get the process done, and the accounts are going to be opened normally that day, and we can get that process started. Second step is funding the account. A lot of times this is going to be the longest step in deciding whether we finish that investment in 7 days or 2 weeks. It's just where are those funds coming from? Like I said, some are very quick. We'll submit a request, and 2 or 3 days later we might have money. And then sometimes we're waiting on a check from an old 401k to get delivered. So that's step two. While that's going on, we can get all the investment documents done, but really step three would be once the account's funded, we're completing that investment, wiring to the sponsor, and at that point, your retirement account is invested into that offering. as a very brief kind of 101, I'm going to open up to questions now, and I'll kind of have that. But yeah, if there's any other questions come up with this is kind of the basics, but we really got a pretty good understanding of at least what the power of the tool is at this point.
Yeah, I've got a couple questions in here, and but I do just want to reiterate that finding a custodian that is a good fit for you and it's just so important because there's so many things that you need to follow and make sure that you're doing properly so that you're not violating any prohibited transaction laws, lending money to your kid. I mean, there's just so much. And
Mhm.
I hear the same stories that Matt does. Hey, I have this E-Trade account. I got my money out. I'm going to go deposit it with Equity Trust. It's like, whoa, whoa, whoa. You just took a distribution. So, the best advice I can give anybody is align yourself with experts like Equity Trust. And I will tell you, I've been in this industry almost 20 years. Equity Trust was the first company I ever had any experience with working with self-directed IRAs, and they are probably by far one of the best. And they will help you with everything. So if you do have an old 401k and you're interested in moving it or setting up a new IRA, call them. They will give you the instructions. They will even, to some extent, help you get that money moved over, has been my experience. So don't be afraid to reach out. They're all, very happy to help you and give you the advice that you need. But just wanted to kind of give a shout out to Equity Trust because I have a lot of clients that use you guys and they're all very happy and Equity Trust understands the alternative investment space. There's other custodians out there that are just getting in this industry and they don't understand what a debt fund is versus a promissory note versus a syndication. So do your homework. I tell people do your own push-ups. I'm not going to tell you who to move your money to. I'll give you, my top three and Equity Trust is always at the top. So I'll get off my soapbox. Um,
Appreciate it.
so somebody said, are there any prohibited transactions or investments I should be aware of? So I don't think you need to go into like every single thing that's a prohibited, but maybe like
Yeah.
some of the most common that you hear about from people that they shouldn't be doing.
Yeah. So as far as asset classes, we kind of talked on life insurance and collectibles. I should touch on that if something is federally illegal, that's also a non go. So cannabis is the biggest one. So we see a lot of
Yeah.
people want to invest in indirectly into cannabis investments, and even if it's legal in the state you're doing on, because it's a U.S. retirement account, not going to be able to be held in a U.S. IRA. So
Okay.
until that's federally legal, that is another asset class I should kind of add on there. Most of the time when people talk about prohibited transactions, they're talking about commingling of personal funds or ways of structuring transactions that could be in it. I didn't really throw it in there. I should have probably mentioned it, but we could probably spend an hour talking about just prohibited transactions. For the most part, what you're looking at is not self-dealing, so an investment that your retirement account makes that you personally benefit from now. So this would be, um, I'm going to buy my rental property from, my IRA, or my IRA is going to buy it from me personally. That doesn't work. This will go for lineal family members as well, so spouse, parents, grandparents, children, grandchildren. You're not going to be able to transact with those people, so purchasing assets from them, even at fair market value. So even if it's not a sweetheart deal, you can't buy from those people. Now, extended family is fine. You can buy from a cousin, a brother, a sister. This is going to be done at fair market value. So still no, I bought it for $1 in my account. Um, you'd want to then make sure it's still fair market value. If you're buying from people who are just non-related, you're not getting any deals, you're going to be good then. And then as far as once the investment's purchased, you just want to make sure that I say you're not doing sweat equity. So if it's a real estate property, this is where it comes at the most. If you're passively investing, um, it's really hard to run into a prohibited transaction. But if you're a little more active in like investing in rental properties, like I said, me and Heather do, you're not able to provide sweat equity to those retirement assets. You're not going to be the one going out and swinging a hammer. You can act passively managed, so I'd say like leasing can be done, but you can't go do a weekend renovation on that property. You have to pay somebody to do that. So like I said, individual real estate or investing in rental properties is probably one where you definitely want to know the prohibited transaction rules. If you're investing with a sponsor, you're a passive investor, an LP, um, you probably don't really need to know them, but it's good for the custodian to keep in mind as well.
Okay. One of the questions I get asked quite a bit, because we do sell notes at Central Lending, so
Hmm.
we sell promissory notes as well as offer options to invest monies in our
Yeah,
funds. But I will get
yeah.
husbands and wives that say, "Hey, we both have equity
Hmm.
trust accounts. He has his IRA. I've got an old 401k. We're looking at buying a note for 100,000. We've each got 50 in it. Could they partner together and buy that note together as long as the payments were split accordingly? Is that okay to do?"
Yes, no, it's definitely okay to do. I should be clear to be technical. You're not combining the accounts, so we're gonna have two
Right.
separate accounts. They're going to invest together. So if we have a promissory note, the lender is going to be, John Smith's IRA for 50%, Lisa Smith's
Gotcha.
IRA for 50%. And then those investment proceeds are split that way. But yes, you can definitely co-invest or invest aside. If you have personal funds, we can even add them as investors. It's just got to be strictly pro rata based on
Gotcha.
the percentages that we invested. So, yep.
So any earnings would need to be pro rata based upon the percentages owned as well as any costs. So if they
Mhm.
foreclosed or something like that and there was expenses to be paid, it would have
Yep,
to be according to the pro rata shares, correct?
exactly.
Okay. I just wanted to clarify that. That comes up a
Yeah,
lot. And it's a great strategy, right? Because
yeah.
it's not uncommon for me not to have enough in my IRA, but I like that note, but I might have personal funds I can add in there, or my husband may have money in his IRA. So,
Exactly.
it's a way for you guys to still be able to invest in things like promissory notes, even if you don't have all of the capital. Understand that you could find another person with other funds or IRA accounts, but as long as, like Matt said, everything is split accordingly. So, just wanted to make
Mhm.
sure we asked that. So we do have a question on here as well. It says, if investing in mortgage notes, how are distributions and interest payments returned? So I think what they're referring to is when you buy a promissory note, most of the
Mhm.
time, not always, but most promissory notes require borrowers to make their monthly payments. Can those monthly payments come to you personally, or do they have to go back to the IRA custodian? Can you speak to that?
Yeah, you'd want the distributions or interest payments to go back to the IRA custodian, even if you do plan on taking those out. So it's very common for especially people who are in retirement already.
Mhm.
They still have these investments active. You want to go back to the custodian because we're going to do 1099 reporting and other reporting to the U.S. government about what comes out of the retirement account. So yeah, it's very common that we'll receive a distribution or interest payment and then immediately send that back to your personal account, but it does need to flow back to the IRA at least initially.
Okay, good to know. And also, I believe at the end of the year, don't you as custodians ask for a fair market valuation of accounts as well? So
Correct.
this would probably pertain more to if you're investing in a fund, like Matt had mentioned, a lot of people, and I call them boring investments. I said, find a
Yeah.
boring investment, find something that pays consistently. And even better, find something that you can compound your earnings, which is just crazy powerful. So you're investing with tax deferred or tax free dollars, plus you have the ability sometimes in funds like our fund, you can actually reinvest your earnings every month. And for a lot of IRA owners, they're not in a position where they're taking distributions, the required distributions, and they're not at an age. So this is money that's just set it and forget it. So
Hmm.
that's even more powerful if you can find those types of investments. Other things I think to take into consideration is the term of the investment you're going into. There are fees involved with moving money around with a custodian. There's transaction fees. So if you're investing in something for 2 or 3 months and then you're going to get your capital returned, make sure that your yields are high enough to recoup and cover the cost, because I did this myself. My husband, I encouraged to buy a note, and it paid off in, I think it was 4 months. And by the time we did the math, we thought we were giving 11% returns. But because the period of time that it was deployed was so short, we actually got seven because we had to take into consideration the fees. So
Hmm.
it's just little things to think about. There are fees involved with this. So just if you have smaller dollars in your IRAs, those are just things to, sometimes take into consideration before deploying your capital. Okay, let's see here. I've got quite a few other questions. So, what are the fees associated with opening a self-directed account? Can you speak to that?
Yeah. So we have different options. So I'll say that depending on your situation, we have about 3 or 4 different fee schedules that we can pull from just to make sure it fits your needs correctly. But generally speaking, you're going to pay about $50 across the industry for a setup. So you're going to
Okay.
create the self-directed IRA and you're going to pay about $50 to set the account. As far as like if you're doing an investment, our clients for their first investment are normally going to pay $530 for the first year. That includes that $50 I mentioned. That is for the first investment, holding it for a year, the annual fee, processing, wire in, wire out, and setup. So 530 the first year, and then generally our best fee schedule ends up being a flat $325 for that investment for year 2 and on. So
Okay.
$325. And like I said, we have some other options in there, but generally that is the most lucrative option
Okay,
for
that's
the account.
helpful. And do you guys have the ability to receive and send ACHs versus paying wire fees? I know that that is
Mm-hmm.
something that's been changing a little bit in the industry.
We do. We
Okay.
try to reserve it for certain thresholds of money. Obviously, if it's a larger sum, we're really going to encourage wire just to make sure that it's received, it's safe. There's no
Okay.
2 or 3 days where we're like, oh, it was sent. We hopefully you got it. You'll see it in a couple of
Yeah.
days. Like we do like the idea, especially for larger sums, that we send a wire, but we can send ACH and we definitely receive ACHs very often.
Okay. Good to know. Um, how about as far as like if I was a client that had a 401k and I wanted to move it over to you, would you guys be able to give us or myself advice on whether I should be rolling that into a traditional versus a Roth? And maybe you can tell them the difference between a traditional and a Roth first, because I don't know that we covered that.
Yeah, yeah. I'll start with the differences. So traditional IRAs, normally when you're putting that money in, so most commonly it's funded through like a 401k, anyways. You're getting that pre-tax, contribution to a retirement account. So that money is you're getting a tax deduction. If you're contributing to a traditional IRA, you can get a little tax write-off on putting that money into a traditional IRA. Um, the idea being it grows tax deferred with a traditional IRA or even a 401k, a regular 401k, when you take that distribution in a retirement account, you're paying ordinary income tax on what you pull out. So that's how kind of a traditional IRA works. You get that tax deferral, but you are going to pay taxes once you start pulling that money out. The nice thing is you get to choose how much you want to pull out in a retirement account and what you want to pay taxes. While Roth IRA, a lot of people are familiar with it, and why it is a powerful tool is it works very similar. It's contributed with after-tax dollars. So you're not getting the tax write-off, or if you're doing it through a employer plan, you're doing it paying taxes first and then putting the money in a retirement account. It grows tax deferred the same way traditional is, but when you're pulling the money out, it's tax free. So even if that money's grown 10 times what you put in, tax free on what you pull out. So that's kind of the basic understanding of traditional and Roth. As far as 401ks, some 401ks have an after tax or a Roth option, not all. So I'd say most 401ks are pre-tax. If you don't know, more than likely it's going to be a lot of pre-tax
Okay.
401k. And then you do have an option for a Roth 401k or an after tax. For people moving over, oh, sorry, yeah.
Oh, no, go ahead.
No, for people moving over, I mean, as far as advising, I'll give my disclaimer that I kind of missed. So we're not financial advisors. Every situation's a little bit different. We can tell you how it would work and some other options that times people don't think of. When they are rolling over, some people are very adamant, like, okay, I want this all to go to Roth. Like, definitely you can do that. You can move, even if it was pre-tax 401k, you can move it to Roth. What's going to happen is you're going to get a 1099 for what moves over. So you're going to pay tax on what goes from pre-tax to post-tax. And then how Roth conversions work, you have to leave it in there for 5 years to get that Roth benefit. So we call that a Roth conversion. You don't have to do that all at once. Sometimes people, it's an all or nothing game, but you can structure that over a certain amount of years also. So we'll have it very common where people will leave a job, move their 401k over to a traditional IRA, and then maybe they take 25, 10% of that account each year and move it to a Roth IRA and just pay taxes, maybe limit that tax bill. So that can be done. You can even do an in-kind rollover, or a conversion, sorry, in-kind conversion. So you don't have to like withhold that money from being invested. You could buy a note and then next year you decide, well, I'd really like that note to be my Roth IRA and decide to flip it into your Roth IRA. So that can be done too, because some people think, well, I can't invest it. That's going to be money staying on the side. I don't want to do that. You can do that as well. So a lot of options, and yes, we can go over those options and see what's best. We're not your CPA or tax advisor, so we're not gonna be able to
Right.
like tell you exactly for you what's best. But if you have a plan in mind, we can kind of give you what those options are.
Yeah, no, I understand that you guys
Yeah.
aren't CPAs and can't give legal advice. And to be honest, I think it depends on the individual investor. I mean, there's a lot of
Hmm.
compensating factors. What is your age? How
Yeah.
much is the account value? What is your income at
Yeah.
right now versus,
Hmm.
if you're almost a retirement age,
Yeah.
and it makes more sense not to convert it, or convert it and then your income's less when you retire. There's just a lot of things to take into consideration. So, like
Yeah.
you would
Definitely.
say, I would probably get with your accountant and do some tax
Hmm.
planning, if that's something you're looking into. But if you're young and you have the ability to open a Roth, I encourage all
Hmm.
young adults go open a Roth. Once you get past a certain income threshold, you don't have the ability unless you're converting traditional accounts into Roths. If you're young, go do it now. They can't take them away, supposedly.
Definitely. Yeah.
Okay, let's see. I've got a couple others. I kind of want to keep this under an hour just because I know it's much later, especially where you are, Matt. So thank you
Hmm.
for doing this for us tonight. This is a good question. Is there any limitation on the amount I can contribute to my IRA every year? Maybe you can just speak to contribution limits. I know it changes yearly.
So yes. So contribution limits to IRAs. Oh man, we're already 4 months in, but at 7,000, I believe, is the contribution limit to a traditional and Roth IRA. And then once you're over the age of 50, you get an extra $1,000 for 2024. And yes, every year they tend to bump it up. $500 is kind of what the pattern's been lately. So I'm sure next year we'll probably get a $500 increase as well to those contribution limits.
Okay.
Now, what is not included in that contribution limit is moving money over from other retirement accounts. That money's already in a retirement account. There's no limit on moving that money over, moving it back. It can move between retirement accounts and you're fine. And if you're contributing to a 401k or an employer plan, those are separate than IRA contribution limits. So you can max out a 401k and max out an IRA, and you're fine there.
Oh, nice. Okay. Good to know. And then probably last, which this is kind of bad that I'm ending with this, but what happens to your self-directed IRA upon death?
Yeah. So highly recommended to list beneficiaries, and your beneficiaries, your heirs can inherit, or whoever you decide inherits that account. So they inherit it within a retirement account. So it's an inherited retirement account. These rules have
Okay.
changed. There used to be some different rules, but currently they'll inherit it and they have 10 years to take those assets out of a retirement account. So whoever inherits your account, if it's a spouse, this is another kind of weird rule. If it's a spouse that inherits the account, it's theirs. It's treated like it's their retirement account. So if that's okay with your planning, that's always kind of recommended to list a spouse as your primary beneficiary because they don't have to remove those assets
Okay.
from the retirement account. If it goes to a non-spouse, they have 10 years to start removing those assets from that retirement account.
And then
Is
if
kind of how that
you
works.
were to inherit a Roth IRA, I've
Yeah. Hmm.
heard recently that that is actually tax-free to the individual inheriting it, correct? They don't lose the benefit of the Roth IRA. Is that accurate?
Correct. It's still a Roth. So yeah, at that point, sometimes when people have 10 years to do it, they'll split up over 10 years. If it's a Roth, a lot of times people are just taking it all out once then because they're not going to have to worry about the tax, complications there.
Okay.
So Roth, another point for Roth being for your estate planning, it may make sense. If you don't list beneficiaries, it goes to probate, and it's split up that way, but still in a retirement account. Um, Another common question we get is, should I list my trust? And you definitely can list a trust as a beneficiary. The trust inherits the account, at least initially. The trust owns the IRA, and then based on the trust guidelines, it's split based on the trust rules. So, um,
Okay.
yeah,
I feel like we could answer questions and talk for another 2 hours. There's so much to
definitely.
unravel with
Yeah.
IRA accounts. Let's see here. I just want to make sure we get them all. This is a good one. How much control will I have over my investment decisions within a self-directed IRA?
Yeah, no, it is a good question. So as the custodian, we actually don't point you in any direction about where you should be investing and what you should invest in. So one of the key things about being a kind of a neutral custodian is the only thing we're going to tell you is whether this can or cannot be held in a retirement account. And then if it doesn't meet the life insurance collectibles or an illegal asset on the federal level, otherwise you have the freedom to invest in what you'd like to invest in. That's really the power of that diversification. We don't have preferred investments or anything like that. We're trying to push you
Mhm.
towards. It's really full control of what you want to invest in.
Hence why it's called a self-directed IRA, right?
Yep, exactly.
Okay, one last question that just came in. Can you invest with your IRA into crypto?
Yes, yes, you can. So Equity has a really good platform for cryptocurrency investing with a lot of different options of brokers you can choose. But yeah, it's become a lot more,
Okay.
yeah, common.
I get that asked that a lot, so.
Yeah, same.
All right. Well, everybody, we're going to wrap things up. Matt's contact information is hopefully still on the screen. I think everybody can still see that. I apologize for your presentation kind of not being the proper size, so I'll have to look into that, but I appreciate Matt being patient with that. If you're okay with it, Matt, too, I
Yeah,
might hand out that PowerPoint to anybody that's interested.
yeah,
So for those of you that attended, or if you're listening to this as a replay, if you'd like to see his presentation so you can see the slides a little better, I'm happy to send that out to you. But reach out to Matt with your IRA questions about setting up new accounts, rolling over accounts. I've had a ton of experience with Equity Trust, and I don't I don't promote people unless I strongly believe in them and have experienced, but they have great customer service at Equity Trust, and I don't doubt that Matt would take great care of you. So I encourage you guys, if you don't have those accounts or you'd like to learn more, reach out to Matt. I'm going to put a little bit more information. We're going to wrap this up here. We just recently opened about 2 weeks ago our newest fund, CL Fund 3. Just as a reminder, if you're not involved, we are still open for contributions. This is our newest debt fund. So it's got a cumulative preferred rate of return of 9%. There is a 75-25 profit share. That means you guys get 75% of the profit above the 9%. This is really powerful if you guys are going to use IRA accounts. You can actually reinvest your earnings. That's what I was talking about. You know, a lot of times these accounts, you're not trying to access this as cash flow unless you're at an age where you need to take your distributions. So you do have the ability to reinvest. So run some numbers on compounding earnings. And this fund's target return is 11%. 9 is just the preferred rate. We've been managing funds a long time, since 2017. We currently have an annualized lifetime yield of over 16%. So we're pretty confident we're going to get that above that 11. This fund gives you a short lockup period of 12 months, so you've got great liquidity. And like I said, it is IRA friendly. So if you guys have interest in the fund, if you want to talk about promissory notes, you can contact me. I have my direct contact up there. I actually put a QR code that's easier for you just to put your information in, and I'll follow up with you guys. But I encourage you guys to educate yourself about IRAs. I don't feel like, I mean, even though there's a lot of webinars and podcasts out there about it, I do feel like it is a little bit underserved. And like Matt mentioned, this is a great way for you guys to create wealth tax deferred. You can even buy real estate in your IRA. We didn't even get into the weeds with that, but hypothetically, you could go buy a investment property, hold it in your IRA, and profits flow back into your IRA tax free or tax deferred. So they're that powerful. So I challenge all of you guys to educate yourself more about that. But thank you guys all for being here. Matt and I are here to answer any of your guys' questions. So you guys have all of our contact info. And Matt, thank you for taking time out of your evening to join us. I appreciate it. All right.
Thank you.
Until
Yeah,
next
thanks for having me.
time. Yeah, we're going to do this once a month. So if you guys have ideas also about content you'd like us to cover, make sure that you share that with me as well. So take care and reach out if you guys have any additional questions. Thanks, Matt.